So how does that differ from private equity buyouts, for example, or venture? I guess versus venture, our businesses, as I said, are farther along their curve. They've gotten farther with their product strategy. They've gotten farther with their go-to-market strategy and sales efforts. And they tend to be closer to understanding sort of what their profitability profile will look like as they mature. But they still have many vectors of expansion ahead of them. And versus private equity, these are businesses that, again, are not at full sort of profitability from a maturity standpoint, and therefore from an investing standpoint are really more focused on and priced on and evaluated on how much growth potential they have ahead of them versus how much cash flow or profitability they have ahead of them. And what that means also is that the skill set is really different. What you're focused on are more strategic questions about the business, about the market, about the product, and competitive differentiation versus others who are riding often the same macro tailwind, like the shift to cloud, for example, in software, or the increased adoption of mobile phones and e-commerce in the consumer world. And so the things you're focused on are much more around the business and its growth options, generally organically, what it can do on its own, versus private equity, where there's a lot of focus on cash flow. The business is fairly mature. It operates in a fairly mature market, and the skill set is often around how do you optimize the capital structure, which is the optimal mix of debt versus equity. Can you engineer the business in a way that delivers more returns to the equity investors of the business, which is the private equity firm, by using sort of clever financial structure? And it's really more about optimization of what exists as opposed to maybe creating new growth options. Although those lines are starting to blur, and private equity firms are certainly getting more thoughtful about how to expand the addressable opportunities for their companies, even if they are putting debt on them and owning a control stake. And that's maybe the last thing I'd say, and I'll turn it over to the other panelists, which is most of the investing that you do in a growth context is minority. Meaning you don't own a control stake in the business, and that influences how much influence you have over the business. And so you're really more a thought partner and a strategic partner than a control operator of the company. So you don't really see us all that often running big operational playbooks, taking cost out of the business, wholesale replacing teams and all that stuff. That's not really what we do. We try to partner oftentimes with the existing management team. Sometimes we'll bring in new talent, but it's really more of a partnership approach than a control approach, since we don't own a majority of the business.